get started. Last class with classification of mutual funds. So we understood there are three different categories of mutual funds based on operation, investment objective, and based on geography. So we also discussed based on execution three different types. What are close-ended funds? What are the features? What are open-ended funds? And the third one is interval schemes. Now, today we'll be moving on to the second category, which is based on investment objective. So, you as an investor will have different objectives, right? If Mr. X has an objective of income, Mr. Y will just have an income, will have an objective about, more of security. Some might have about capital appreciation, some will have objective of immediate return. So that way, each investor will have different kinds of objective behind their investment. So here we talk about the first one, income schemes. This fund aims at generating and distribution of regular income to the members on a regular basis. So this category, the first category, belongs to people who want regular income from their investment. Okay, regular income. Now, when I'm talking about regular income, first, what are the options that I come across? One can be debenture. Remember, I cannot go for equity in this scheme. Why? Because equity, does it give you a promised return every year? No. If there's profit, you will get dividend. If there's no profit, you have to bear with the loss. But in this category of investors, are they focusing on, adjusting with loss? No, they're demanding income on regular basis. That way, which is the best option? Debentures. Because debentures are paid interest irrespective whether the company earns profit or faces loss. You got my point? So this income scheme focuses on such fixed income securities. So let's see here. It concentrates more on regular income, and it also sees that the average return is higher than that of income from a bank deposit. So definitely mutual fund or this particular income scheme under mutual fund should offer on an average a little bit higher return than what the bank deposit can offer. If the same corpus amount was deposited in the bank, what interest rate the bank would give, right? Let's say rupees 5 lakh is the corpus capital. On 5 lakh, let's say the bank gives you 6% rate of interest. Mutual fund must be able to give little bit higher than what the bank gives, let's say 6.5 percentage. Got what I'm telling? So here the mutual fund aims at giving a higher return when I'm comparing the same investment with that of a bank deposit. Is that clear? That's the first one, and it also concerns with short-term gain only. Mostly the pattern of investment is oriented towards fixed income securities like debentures or bonds. As I told, debentures combines with companies, bonds can be government bonds, right? Now it concerns with short term gain only. Now there can be few people who say, I do not want regular income, like let's say for an example, I'm getting a return of rupees 100 every month. I don't want that. I want one shot, once in a year, I want 1500 rupees. Okay, that is long term gain. Understand, you're not focusing on shortly how much you're receiving, but on a lump sum, you want a return. That is different. Here, when I'm talking about regular income, I'm talking about short term gain only. That means you want an income, even though it's a lesser income, you want it regularly. Okay, that falls under the category of short term gain. Understood what is income schemes? Next, second scheme is growth funds. To achieve capital appreciation is the objective of the scheme. They concentrate mainly on long-term gains. I just told you, correct? Long-term gains. They invest in growth-oriented securities. Now here, income schemes were short-term gain. That means you're earning small return, but regularly, maybe 100 rupees per month you're earning, and you're earning that every single month, 100, 100, 100. So that's constant. But here, what am I talking about? growth funds. What is their objective here? Achieve capital appreciation. Okay, so here growth funds, the investor objective here is not immediate or regular income. They want a lump sum amount on a long term gain. So they're not receiving every month, but once in a year they'll receive 1500 or 2000 rupees as a return on their investment. Is that clear? So this is called as growth funds. To achieve capital appreciation is the objective of the scheme. They concentrate mainly on long-term gains. So where do they invest this money? The corpus of this capital, they invest in growth-oriented securities. So they invest in certain securities of companies. Maybe right now they're not earning profits, but as in days go by, maybe months and years go by, the company starts booming or the company has super profits, and then you will have more amount of returns. That means you will have to wait for certain time period to get that lump sum amount of return. Is that clear? You need to wait to get a lump sum amount of return from your investment. That's why it's called as growth funds. If I have to receive regularly, maybe I'll just receive 100 rupees one month or 50 rupees one month, like that. But if I'm waiting and making sure the company grows and the company is, having a very good income position, then one shot I can receive a long-term gain. Is that clear? So that's the second objective or the second scheme of fund called as growth fund. Number 3, balanced fund. This is also called as income fund, income growth funds. It is a combination of income and growth funds. So here it's simple. What you studied as the first part income funds and what you studied as the second part growth funds, here it is a combination. That's why it's called as balance. So in this category, there are few people that sometimes need regular income. Sometimes they tell, I need long-term gains. Some short-term and some long-term. So in order to have a mix of this, they call that scheme as balanced funds. Why? Because under this fund, you're not only investing in growth oriented securities, but you're also investing in fixed income bearing securities. That means you're investing in equity and you're also investing in debenture. So that is the position of balanced fund, right? It is a combination of income as well as growth. Point 4, tax saving funds. To provide tax benefits, this scheme is initiated. Tax saving mutual fund is also called as equity linked savings scheme. In short, we commonly call it as ELSS. Is a mutual fund scheme that invests in equity and equity related securities. Now, we know that wherever we are investing, no matter which investment, we are always taxed, right? We always have to pay a part of our income, a part of our return to the government. And nobody, I'm sure, would love to pay taxes. Everybody would try to avoid taxes or do some kind of tax planning in order to avoid paying the government. So here is one such plan called as under mutual fund, tax saving fund. So the name itself is called as tax saving. That means whatever amount you return you get from this investment is absolutely tax free. Okay, is absolutely tax free. Will people be attracted towards this fund? Definitely yes, because they don't have to pay what? Taxes, and that way it will get more number of investors into this type of fund. So what is the aim? To provide tax benefit. So where do the money goes? Where do the money go in this scheme? In the scheme called as equity linked saving scheme. It's called as ELSS in short. It's a very commonly called as ELSS scheme. Okay, that invest in equity and equity related securities. Is that clear? This is the fourth type, tax saving fund. Number 5, sector funds. Investment in securities of certain industries where the risk is confined to a particular sector. Now here, until now we just talked about equity, debenture, fixed income bearing tax. But the point 5 sector funds refers to certain industries. Now in our entire Indian economy, we have so many different sectors, correct? We have pharmaceutical, we have FMCG, we have automobile, right? We have so many other sectors operating in our country. Now each has its own prominence, and each are interdependent upon other sectors, correct? Now here when I say sector funds, that means I'm confining my risk only to FMCG sector. Now whichever companies deal with FMCG means what? Fast moving consumer goods. Fast moving consumer goods. So you need to immediately consume those food products. You cannot really store it like you store clothes, or you store your electronics, correct? It has to be moved fast in the market so that it be consumed, otherwise it's a waste, correct? So there I'm talking about FMCG industry. So whatever funds that I collect under this scheme called as sector funds, I will only allocate it to FMCG sector. Okay, so whatever risk is allotted or risk is associated with this particular sector will only be affecting my investment. If something happens with pharmaceutical sector, my investment is not affected. If something happens with IT industry, this sector is not affected. But any changes with FMCG businesses or companies, etc., my investment is risky, or my investment can get risky. Is that clear? So that way it can be automobile sector, pharmaceutical sector, information technology sector, IT sector, etc. So all the corpus or capital that I collect in the form of sector funds, I will invest in particular sectors in the economy. That way, other sectors, whatever changes are happening, it does not necessarily have to affect my industry. So if I'm putting it into information technology, let's say there is a price increase or decrease in petrol, will it affect my investment? Will it affect the sector of information technology? Definitely not. But then that change in petrol prices might affect the oil and gas industry or oil and gas sector, correct? So that is what I'm talking about here. The risk is pertained to particular sector. It can be any sector. Got it? So that is about the fifth type. Sixth one is specialized funds. They offer special schemes to meet special needs of specific categories of people like pensioners and widows. Now, mutual funds also focuses here on special, needs of specific people in the society, such as pensioners and widow. Now, why is it called as specialized funds? Because they focus and they understand these are the people who do not have a stable income, and they're very much dependent upon these investment schemes. I'm sure when they're investing such people, right, pensioners or widows, into this mutual fund schemes, they definitely are in need of financial assistance. So that is why any other sector, if you're going to put in other schemes that we said, the top 5 schemes right now, there is some kind of risk always involved, correct? Now here I'm focusing on widows and pensioners because I make sure I give them a fixed return and a regular return. Why? Because they are completely dependent upon it. So I need to be more, be sensitive about the kind of investment I do, and the income that I generate, and the same income to be paid back to the pensioners and widows. Is that clear? So that is about the specialized fund. Number 7, gilt funds. Gilt funds, always remember it refers to RBI or Government of India. Gilt funds, if you come across in your mind, it has to connect you to Government of India. What is it? These funds invest in low risk debt instruments such as government securities, which ensures the preservation of capital along with moderate returns. The RBI lends money to the government after borrowing from other entities such as insurance companies and banks called as gilt funds. Now, in case government is in need of money or needs some financial assistance, in that case, RBI lends money to Government of India in which form? In the form of gilt funds. Okay, in the form of gilt funds. So they invite the public. Okay, it can be insurance company, it can be banks, or it can be any institution, or it can be individuals like you and me, right? These gilt funds are open to everybody, and RBI says you can purchase these gilt funds or you can invest into these gilt funds, because these funds are invested where? In government securities. That way, whatever the public or institution puts money into this fund, it goes directly to the government of India. Right? First thing, what did I tell? Government might be in need of some financial assistance. So once all the people pull in money in gilt funds, that money goes to whom? In financial assistance to the government of India. So who collects or who organizes this fund, or who guides this? It is Reserve Bank of India. Is that clear? So gilt funds, where does it invest? In low risk debt instruments of government securities. Right? Now, compared to all the private securities and all the private companies we have in the society today, everything is uncertain. Correct? Today it might be very promising and gives you a very good return, but tomorrow there is possibility that the company might shut down, or the company might be a fraudulent company, right? So all my investment is a loss. But in government, it is always secure, right? Government securities are the most secured ones for investors. Can the government shut down? Can the government run away from us? Definitely not, right? So our money is always safe and secure with government. So that's why gilt funds aims at completely raising the capital, and the capital will directly be invested in the low risk debt instruments. That's why it's called as low risk. So there is very less possibility that you will lose your money. There is very less possibility or chances that you might lose your money. What does this fund aim at? It ensures preservation of capital along with moderate returns. Okay, it might give you a very less return, but it is a promised one. Okay, it cannot be backed out, or it cannot be broken in between the time period of the mutual investment, but it will provide you the promised return regularly without fail. Is that clear? So this is called as the concept gilt funds. GILT, gilt funds. Hope you've understood the first 7 different types over here. We started with based on income investment objective, income schemes, growth funds, balanced funds, tax saving funds, sector funds, specialized funds, and gilt funds.